So today we are talking about risk and reward. But I think before we get into that, a good place to start this discussion is talking about the difference between gambling and investing. And I think people think of this as a really black and white thing. They think either like, oh, you're gambling or oh, you're investing. But I don't really agree with that. I think in our world, we typically live on a spectrum, and it's good to think about these things as a spectrum. So I think it's pretty easy to define gambling. You could think of this as something like the lottery or potentially playing some game at the casino, some slot machine. So these are pure games of chance. There is no edge to be found. And then on the investing side, maybe you can think of some things like bonds, for instance. So maybe over here we have bonds. Maybe as we move from the investing side of the spectrum to the gambling side of the spectrum, we have something like an index fund. Maybe as we keep moving down, we have individual stocks. Maybe if we're even closer to the gambling side, there's something called options or derivatives. So this is you're betting on essentially the price of an underlying asset over a specific time. So those carry quite a bit of risk. But I think also coming back from the gambling side, there are games that aren't pure games of chance and they also have a skill component. So maybe this looks like poker or blackjack. So the important thing to note is as we move from investing over here, we're going to have the potential for more returns, which I am going to talk about just here in a second. But we need to understand that as we move farther away, we're going to be taking on more risk. So we can't afford to take on more risk than we're comfortable taking. And this is going to depend on basically the circumstances we're in, the experience that we have, all these sorts of things. So risk and reward. These two things are tied together. You can't separate them from each other. And we'll talk about that why in a second. But for zero risk, you can get some reward. So maybe this is a high yield savings account. Maybe this is a really short term bond backed by the federal government. In that case, you do have some amount of risk, but it's fairly small. So we'll consider that as the starting point. And as we move through the risk side of the spectrum, we're going to have the opportunity for more reward. So this really hinges on an idea called the efficient market hypothesis, which I'll probably do a whole video about. But in essence, if you could get a high return for zero risk, everybody would take that opportunity. So people would pile in, they would push the price up, and in essence, that would lower the risk, or lower the return. So that really can't happen. So in order to have more reward, you need to take on more risk. So that is going to lead us to the next slide, but I do want to define two terms, what we mean by reward and what we mean by risk. So in this case, reward means our returns. So how much money we can expect to make from holding some financial instrument, and risk means the volatility. So how much that asset is going to essentially move up and down. So I think it'd be good to draw a picture of this so we know what we're talking about here. So I have a linear plot and a log plot. I'm really not a huge fan of linear plots, but I think it will be good to start there. So some compounding effect is going to look like exponential growth. So for the first little bit, it's going to seem like nothing's happening. And as we go on, it's going to take off. So you can, when you do financial modeling, a lot of the times you'll pick some return, and that will be an assumption, and you'll have an upper lower bound on it, but you'll kind of think of it as some smooth line. But in reality, that's not really what happens, right? So in reality, if we were holding this financial asset, the price is going to move around, and it's going to take what we call a random walk, but it will essentially oscillate around that line. So what that will look like in our log plot makes exponential processes look linear. So maybe we have some return. It will look straight on this line. And around that, we have some volatility, some risk. So again, it's going to be a random walk on the short term. You don't know what's going to happen. As time goes on, you have a higher expected value. That's sort of the definition of investing, right? It's a positive expected value game. So the longer you do it, the better chance you should have of returning something. Gambling, on the other side of things, the longer you stay in a casino, the better chance you have to lose your money. So we have some return and some risk, some volatility oscillating around there. So maybe we opt for a financial instrument with a lower return. And because we're opting for the lower return, we're going to get the lower volatility around there. So our oscillations, our random walk is going to be less severe. So really importantly, what I want to point out is time. When you're thinking about investing, you want to think about this in probably years, but it might be even to think better to think of it in decades. So I'm going to think of my investing in decades. We're going to be alive a long time if we're lucky, and this is a game that is going to last for our entire life. So risk is tied to return. The more return you want, the more risk you have to take. One last thing I want to talk about is what's colloquially known as the bell curve. The more proper name for that is a Gaussian distribution or a normal distribution. And this is going to connect back to the plot that we drew over here in just 1 second. But essentially what this means is a lot of things that we encounter in our normal lives are distributed in some predictable shape. So you can define this with just two numbers, some average and some standard deviation. So perhaps we can think about something like height. So something like height, there's a fairly large standard deviation. People's heights can be drastically different. I'm a very average height, but there are NBA players that are very much outliers. So there are many standard deviations away. So we'll pretend that we have some curve for height, some bell curve. Not a perfectly drawn curve, but it gets the point across. So the important thing to note about this is the area under this curve, if we looked at all of this, is going to add up to be 100%. So all of our data points are going to lie somewhere under that curve. And what the mean and the standard deviation, so in this case, in the United States, the mean height is somewhere about 5'9". So the mean will be in the middle, and the standard deviation will tell us how far out and how unlikely certain things are to occur. So height will be quite spread out. We could have something that is way less spread out. So maybe something that's way less spread out, and I'm going to draw this on the same plot. Really what you would have is it would be skewed, or not skewed, but offset to the left or to the right. But just for simplicity, I'm going to kind of draw it on the same plot. So if you were looking at something which was very predictable, maybe how many ounces of soda are in a can of Coca-Cola. So a can of Coca-Cola, typically 12 fluid ounces, and there's machines at the factory that are very precise, and they can very accurately put soda in those cans. So maybe that distribution looks something like this. And I guess I'll use a blue for this one. So we're going to come across, it's going to be way high up on here somewhere. It's going to be very, very peaky. So our normal distribution is going to be very, very peaky. So a lot of the sodas, and again, not to scale, but in this case, we're going to have 12 fluid ounces. So those sodas filled by those machines in those factories are going to be very, very close to the 12 fluid ounces. And this might seem very unrelated to what we just talked about, but in fact, it is incredibly relevant. So when we come back to our original plot here where we started, talking about risk and returns, or reward and risk, we can think of this risk as that bell curve, as that function. So when we're farther out, we can think of our returns more like the height of people. So more like the height of people. So it's more spread out. So as you go out and take on more risk for more return, you're going to have a more spread distribution. So as you come down here, it starts to get a little peakier. And down here at the beginning, close to the beginning, it will be very peaky. So essentially, as an investor, you're getting compensated for taking on more risk. So you're getting compensated because you're holding on to assets that people are going to get typically shaken out of easier. So the last place we need to wrap up this conversation, maybe one of my favorite parts, is well, why would you take on more risk? Well, when I'm teaching the kids about some of these investing topics at my day job as a math teacher, we talk about risk and reward. And the way I like to explain it is you can choose or elect to take no risk. I could choose to take any savings that I had and put them into the freezer. So I would not be taking any risk. I would not be getting any reward from that. But we have an important phenomenon that we haven't talked about yet, and that is inflation. So really what's going on is we have this high watermark that's always increasing, and inflation runs at different rates at different times. But I'm just going to come in here, all capital letters, because this is very important. So you can elect to take no risk. You can elect to take your money and put it in your freezer. But if you do that, you're going to have 100% certainty that inflation erodes away your earning power. So what we need to do, in essence, is figure out how far along this curve we are comfortable being. I would argue that if you're over here and you're not taking any risk, a lot of your return, and I kind of have an error bar here, but a lot of your return is going to get eaten up by inflation. So you're just going to be treading water. So based on the income, based on where we're at in our life, based on our risk tolerance, we need to figure out where we live on this curve. So that was just a quick introduction to risk reward, gambling versus investing. But I hope that was helpful, and I hope you learned something.